price. First quarter of 2022 already passed, and we would like to review what have been right and what have been wrong about the market. And then we would like to predict what will happen because of this event happened in first quarter and what it will translate into market performance in quarter 2 of 2022. So our market reading in January are generally correct. We see many Asia and global investors suffer in 2021 due to slow reaction to drastic fundamental changes in the US interest rate upward trend and also strategic change in China government policies towards business practice. We saw the liquidity withdrawal in many aspects has negatively affected the high valuation and especially the thematic sector in the global developed market and also in Asia. And we also see the polarization of investment return. What it means polarization is some is very good, some sector or subsector are very bad on different asset classes. And then we also see what we have recommended in January, the investment strategy and tactics. The general framework is still working well until now. So let's see, in the Q1, according to any website data, we saw the US S&P 500 index has corrected around 6%, Bitcoin corrected 10%, Nasdaq corrected 13%. Nevertheless, we saw the S&P index in the public website showing that country energy sector in Europe, Japan, Australia, and Canada registered positive gains from 39% to 18% positive, which is a big contrast with the negative return registered in Q1 for Nasdaq and the S&P 500. And we saw not only energy sector, while materials and utility sectors also register positive gains, generally speaking, for many developed markets in quarter 1. We saw quite a disappointed performance in the global fixed income instruments, like the US fixed income, in the Canada, Australia, UK, Europe, Japan. You saw all the red color is what we got to see in the S&P public website about the performance of the fixed income benchmark that published by the S&P due to the interest rate upward trend. We also see the sharp correction continue from the beginning of January, generally speaking, because of the tightened liquidity. This is what we think. And we saw the meta-universe concept, the new fintech, the innovation, new economy, ETF, all the performance has been quite negative. The Bitcoin, in a relative sense, is relatively better. We thought is due to the gradual acceptance by global investors. Especially, we saw some emerging market countries accepted Bitcoin, as a form of payment, And also, we saw the Russia and Ukraine conflicts have been also make people try to diversify the source of receivement and payment of money in terms of. Also, we saw the equity index globally in many countries also showing polarization trend. One sector, subsector is doing very good, while the others are doing very bad. Especially we see the IT sector, consumer discretionary sector are performing double-digit negative as shown in the chart, while the energy sector, generally speaking, have double-digit gains. So we see some country index are performing quite well, like South Africa, Latin America, and the All Australian 50, compared with the Asia 50 and the China 500. We saw also green bond, select ESG, also have a negative almost 8% return in Q1 2022. We saw there are a lot of shifting of liquidity among country equity index and also with different sectors. And we saw favorable sectors, as we said, is energy, material, utilities. While Asia generally and the developed market have suffered negative return in the Q1. And we see investment tactics and strategy that we propose someone to think about is still valid. Like you have to think about stop loss, lock-in profit, and really think deep how the China political ideology has been applied to business practice and what is the implication. And then we see money flow, the polarization is caused by this money flow, which is quite drastic. And also see a lot of the trading activities has been affected because of the interest rate increase, which directly affect the funding cost of the trading funds or hedge funds. So we see the global geopolitical tension heightened to decades high due to the war in Ukraine, and there are quite direct impacts to global liquidity, supply chains, and also to all the global financial markets. We expect to see continued strong US dollar, higher US interest rate as already announced by the US Fed, higher trading costs as a consequence, and we see another quarter of consolidation is possible for both fixed income and equity asset class, and the supply chain disruption, it seems, will be there, and the inflation number definitely will be higher in the developed world, and it's time for investors to do more in-depth research on their potential investment targets. Of course, always we have to do our own due diligence before investing and invest according to our own risk tolerance and absolute loss absorption capability. The key takeaway, we saw investors are quite hesitant in the Q1 and the Q4 of 2021 to do the rebalancing of portfolio And after the sharp correction, we also see there are some more rebalancing is going to happen. We can see China central government's imposed directive will stay in imminent future. And people have seen this determination, and I don't think that it will be reversed in the coming short period of time. So withdrawal of liquidity because of the interest rate hike in US and other central banks will make the excessive liquidity sensitive themes, the sectors like the new economy, like the cryptocurrency under pressure. Yet, as I mentioned, cryptocurrency is relatively well supported on weaknesses because of the political tensions among big countries. And it's time for the investor to do more in-depth research into some target investment that suit their risk appetite. For retail investor, I would like to say we have to be always careful about various promotion of investment funds. Especially we have to pay attention to the cost, to the expense involved while we investing in those funds or structured products. It will take a long time for us to recover the cost if we are investing in a wrong timing or in a wrong product type. That we have to be very careful. So I have a question from my investor. The question is, in view of the strong US dollar and super weak yen, Japanese yen, why don't the trading fund, the hedge fund, borrow billions of weak Japanese yen to trade the US stocks? My answer is, in this kind of trade, there are two kinds of risks that we need to consider. One is the FX risk, FX, foreign exchange risk. The Japanese yen has been weak for quite a while and is quite sharp recently. So any time for technical rebound or fundamental rebound for whatever reason will trigger margin calls because of the P&L reversal for the trade. This is quite a possible risk. And also with the recent Russia-Ukraine war, trigger the nerve of diversification from US dollar as a reserve currency for some countries. I suspect there are some countries are doing it, for whatever reason. And also with the rise of digital currencies such as the cryptocurrency are posing real challenge to conventional currencies. The second risk we have to think about is the outlook of the US equity. As we already saw the sharp consolidation on thematic sectors, it may continue for another quarter due to the tightening of liquidity. The spill out of these negative losses from the new economic sectors may make the conventional sector also suffer. Imagine when you have the new economy exposure and the conventional exposure, while conventional still have some profit, while the new economy have some loss, you will try to neutralize your profit and loss by selling both. So overall, to reduce the exposure to equity asset or risk asset. So So that's the reason, two reasons that I think is not such a favorable trade for the trading funds at the moment. Welcome any question. Wish you a very good and exciting investment journey ahead. See you next time. Thank you.